India's banks, they are in best of the health. They have increased the profitability by 4 to 5 times in the last 3 to 4 years. The capital adequacy ratio is also well within the comfortable zone. And they have moved out of the period of twin balance sheet problems as highlighted by the economic survey, wherein the gross non-performing assets have gone down from 11.2% in FY18 to 2.8%. But still, the banks are now facing a peculiar problem, and that issue is credit to deposit ratio. So what is CD ratio? So CD ratio is a ratio which defines total gross advance upon the total deposit base for a bank. In a nutshell, we can say that it's all about the total amount which has been lent by the bank out of the total deposits that it has mobilized. Technically, if the CD ratio is within 75%, then it is considered as healthy. But of late, it has been found out that the CD ratios of some of the banks have hit even more than 100%. That means now they are actually lending the money by borrowing money from capital market through certificate of deposits. And those money are costly. But what are the major reasons behind this? The main issue is lower deposit rates, and that has prompted many depositors to shift to capital market instruments, specifically the equity market, either through direct equity investment or through mutual fund. If we see the growth of mutual fund, the asset under management for mutual fund has risen from 10 lakh crore in 2014 to more than 60 lakh crore in 2024, and that shows more than 6 times increase in the last 10 years. Apart from that, there is another issue, the CASA deposit rates. So the current account and savings account rates out of the total deposit base has fallen to 41%. And since these particular deposits are low cost, in a way that increases the net interest margin for the banks. Now, if they resort to certificate of deposits, then the interest margin would go down, and in a way that would be a kind of interest rate risk wherein the profitability for banks would increase. Apart from that, not all banks, the smaller banks cannot access fund through certificate of deposit, specifically the capital market, because nobody would be actually buying those certificate of deposits. So technically, the democratization of lending does not happen. Apart from that, if we talk about if there is higher rates of credit because of the deposit crunch, what happens that the credit creation in the economy would go down. In a way, that would hamper the capital formation in the long term. And if the capital formation, or in nutshell, we can say if the investment rates in the economy would go down, then it may hamper the consumption expenditure in future time. And at least what would happen that you can say the cost push inflation, because of the cost of capital or the credit cost going up, the cost push inflation would go up. In a way, that would hamper also the purchasing power for the normal public. So what should be the way forward? Ideally, banks should think about tweaking the deposit rates. They should make the deposit rates more attractive so that the depositors now should feel more attractive to park their excess fund to the banks rather than going to the capital market or equity market. Or else, if there is any stock market correction, then that would prompt again the depositors may be again coming back to the banks rather than going back to the equity market. So it's all about the market play which would happen in the due course of time. This was all about the credit deposit ratio. Thank you.